Welcome to Investors Insights, where today's topic is market momentum ? We're coming off a great week for the market, and in today's vlog, we want to tell you why it was such a great week. So, Trey, I want to start with you. We got big news from the Treasury, something that we really don't talk about a lot, that the market liked. Talk about that.
Yeah, absolutely. And what will be a market moving event going forward until we get a handle on interest rates and debt issuance? The U.S. Treasury Borrowing Advisory Committee announced what type of debt they will be issuing to fund the government going forward. This has been a ho-hum event for the last 20 plus years. It's now become market moving. We saw interest rates fall on the news, and that's something we haven't been able to say in a long time. Interest rates fall. The 10-year Treasury moved from 4.9 all the way down to 4.57. That is an enormous move in less than a week. And we saw the stock market, go opposite of interest rates. Interest rates fell, stock market rose. So what did the Treasury do to cause stock market to rise? Well, here's some data that sounds negative on the face of it. They announced that they will need to borrow $776 billion in the next quarter to fund the U.S. deficit. And then they will need to borrow an additional $816 billion in the following quarter, the first quarter of 2024, for a total of $1.592 trillion. To put that into context, the total U.S. credit card debt accumulated up to this point is just $1.03 trillion. So there's a lot of debt that is going to have to be generated and issued in the next 2 quarters. So how did the market take that positively? Well, it came down to really one sentence, and this is the longer dated debt would increase at a more moderate pace. So what does that mean? The Treasury gets to decide how it's going to fund this deficit. It can fund it with 3-month T-bills, 1-month T-bills, or it can fund it with 30-year Treasuries. And so what has happened is that that is the Treasury saying to the market that we hear you. The market has been pushing up long rates, and which is pushing down the stock market, and the Treasury saying, we hear you, market. We hear that you do not want these long bonds, and so the Treasury will be issuing less long bonds. Now, it's kind of a form of kicking a very large can down the road, because if you issue 3 months Treasuries, you got to be here in 3 months and do it all over again. But the market clearly wants short-term debt. All those money markets and CDs you see advertised, all that is backed by short-term Treasuries, and that is where the demand is. So it shows that the Treasury is very cognizant of what's going on in the market, and we think that was the takeaway that saw not only the stock market but the bond market really have a very strong close to the week of what could have been a very negative report.
Yeah, Trey, it was great to see both the stock and bond market up on the same day. Both had great weeks last week. And if you watch our vlogs, you know that we are big fans of historical performance of the market through different periods. And we mentioned back in September that the market historically struggles in September through October, and that's exactly what happened. And so looking at this chart, the S&P 500 finished up the widely watched sell in May period from May through October with just a modest 0.6% gain. Historically, this 6-month stretch has been the weakest for the index, averaging only a 1.6% return. But fortunately for investors, the next 6 months look much better from a seasonal standpoint. As always, no guarantees, but the S&P 500 has generated an average return of 7% from November through April, marking the best 6-month period for the market since 1950. Furthermore, the S&P 500 has finished higher during this time frame 77% of the time, marking the highest positivity rate across all other 6-month periods. And the second is December to July at 71%. So again, no guarantees, but from a seasonality standpoint, it's looking good. So we're watching the market carefully to see if seasonality set up for the market will be a tailwind for the market. And then Ty, talking about market momentum here, jobs report last week, the lower number actually was a good thing for the market. Talk about that.
So we got the October employment report. Non-farm payrolls increased 150,000, which was below the consensus expectation of 180,000. However, payroll gains for August and September were also revised down by about 100,000. And so, another headline number here, unemployment rate ticked up 3.9%. Average hourly earnings rose 0.2%, which was, a little bit less than they had been rising in the past. And so on the surface, it doesn't look like a great report, but kind of counterintuitively, this is a good report. This is exactly what the Federal Reserve and a lot of investors want to see. Slower payroll growth, slower wage growth, higher unemployment rate. Unfortunately, those are things that can also lead, towards a recession at some point. However, it's important to know that, the Federal Reserve, by raising rates as much as they have for the last year, year and a half, they're trying to slow down inflation. They're trying to slow down growth. And so this report is exactly what that provided. Kind of digging in a little bit deeper, I mentioned that the jobs reports for the last couple of months were revised down, and this one was a little lighter than expected. Also, total hours worked in the private sector fell 0.3%, which is the equivalent of losing about 350,000 jobs. It's important to note that the job report is a lagging indicator. And so a lot of times we'll see a lot of things happen first, and then the employment report will kind of confirm what's going on. And I think we've seen that. We've seen inflation come down, and now the employment report saying, on top of that, wages aren't growing as fast, and then the unemployment report is growing. And so want to keep an eye on that. But, overall, kind of a good report for what the purpose is here of the Federal Reserve.
Yeah, thanks, Ty. So the market liked what the Treasury did. The market liked the jobs number, and we're heading into a seasonality that has historically been a good setup for the market. So we're looking for market momentum to finish the year strong. We'll keep you updated. If you had any questions on anything we discussed, please call us, email us. We love to hear from you. Have a great week. Thanks.